Hi, Matthew Atkins here, Senior Financial Advisor with Clearbrook Investment Management and also a National Social Security Advisor certificate holder. One of the big questions people ask when it comes to planning for retirement is how to reduce their taxes. That's especially true of people who are thinking that taxes are likely to go up. You might want to ask yourself that question. What do you think? 10 years from now, 5 years from now, 15 years from now, do you think taxes are going up in the United States or are they going down in the United States? If you anticipate, like many of us do, that taxes are likely to go up, then your planning for how you look at the future with regards to your retirement accounts is very, very important. So I want to talk to you about three basic buckets. You have, for example, the tax deferred bucket. That's your 401k, that's your IRA accounts, your SEP IRA accounts, your simple IRA accounts, your 403b, your 401a accounts. They're all those accounts that allow you to deposit into them now, get a tax break for doing so, and then later, in your retirement years, you begin pulling out of those funds. As a matter of fact, if you don't start pulling out of those funds by the time you reach age 72, the government mandates that you start pulling out of those funds. It's called the required minimum distribution. So let's say you rack up, a nice nest egg of $500,000 or $1 million in those various accounts. What are you going to do if in 10 years or 15 years when you need that money, tax rates have doubled? How's that going to affect you? Doubled, you say? You think to yourself, there's just no possible way that they could double. Well, let me talk to you just for a minute before I talk about the other two buckets of the three. That was the tax deferred bucket. Let's talk a little bit about what's going on in our country with regards to three areas: our debt, our deficit, and our GDP, our gross domestic product. There's a difference between those three things. The debt is really the total amount that our country owes. Much of that debt is not even held in this country. In other words, we owe it to other countries, other sovereignties that hold that debt. The deficit, which oftentimes people use synonymously with debt even though it's not, is the gap between what our country collects in taxes and what our country spends in a year. That deficit continues to grow. I'm going to talk more about that in just a minute. And then the last one, GDP, is our gross domestic product. That's the total amount of goods and services that our country sells, produces every single year. That includes what we ship overseas and what we sell here domestically. The difference between our GDP and our deficit is a very, very important thing because that's what creates that shortfall in terms of how much tax revenue we get. GDP creates a certain amount of tax revenue, and if we don't get enough tax revenue to cover our spending, then guess what? We increase the deficit. Right now, our national debt here in 2021 is about $27.5 trillion. Trillion dollars. Now that is an unreal amount of money. And our deficit continues to grow. So, for example, that does not include the current almost $2 trillion stimulus package that right now a government is considering. Well, how are we going to pay for that in the future? During the early part of the Trump administration, Trump followed the path of Harry Truman, who after the Second World War, when tax rates were at the highest level they've ever been in this country, started pushing taxes down. It was actually a really good move because it left more money in the pockets of the US population, who then were able to grow the economy out of that really difficult and very high, by the way, deficit spending during the Second World War. But Truman did something that Trump didn't do, and that is Truman actually reduced government spending. So the government spending in this country, he dropped down in 1947 from $80 billion to only $35 billion. He cut it more than in half. Now you can imagine what a toll that would take on the government programs that are going on. What we did is we reduced taxes without cutting spending. As a matter of fact, we reduced tax revenue and increased spending. Now, here's an interesting fact. The US government, as a percentage of the overall US economy, early on in this century was about, 2%. You know what it is now? It's about 22%. So US government, the government institutions, they don't actually produce product. So The only way to fund those is through expanding the tax base. That is, increasing the gross domestic product, which then also increases tax revenue, which then can cover the massive expense of our growing government. So when you look down the road with the government taking up that much of the economy and programs continuing to increase, is it possible for us to actually have taxes decrease? How do we meet the needs of the ever-growing social services that we provide? How do we meet the needs of the demands for minimum wage increase, or the demands for college debt to be wiped out, or the demands for free state college for students in this country? What about the growing need for health care in this country? How are we going to meet those demands without increasing taxes? We live right here in Northwest Washington, right across the border from beautiful British Columbia. I lived in beautiful British Columbia for about 9 years. Wonderful province. And if I did a comparison of tax rates between us here and British Columbians there, where they have, for example, socialized medicine, which a lot of people would like to see here, at $175,000 of earned income here in the United States, about $2,000 of that would push you into a 22% tax bracket. Only $2,000 of it. Do you know where you would be in the upper 15,000 or more up in British Columbia? 46%. 46% of your dollars would be going to taxes. That's between provincial and federal tax rates. So when we think about increasing social programs, we have to realize it's going to come at a cost. It's not that we shouldn't do it. It just means that we need to really think seriously about how we're going to pay for those costs. And that's a very challenging thing, because right now taxes are still historically low. And if we think that over the next 10 years, taxes are likely to go up, then it becomes really important what you do with your 3 types of tax buckets. Tax deferred bucket being the one that most people are plowing a lot of money into and is going to be then taxed when they take it out in the future, when it's likely tax rates are going up. The second bucket, by the way, is the taxable bucket. And the taxable bucket has to do with your investment accounts, savings accounts, CDs, money markets, stock funds, all those monies that you invest that are post-tax dollars. You already paid tax on it and they go in there. Well, those are going to be affected by capital gains tax. And every time you liquidate one of those stocks or mutual funds, you're going to face capital gains tax. Real estate could be thrust into that as well. Because at some point in time, if you have rental real estate or vacation properties or something, that is going to be subject to some kind of capital gains tax down the road, unless you do a 1031 exchange over and over again. And I'd be happy to talk to you about other options for that too. The third one is the bucket of the tax-free bucket. The tax-free bucket is the one that has to be actually tax-free, free from income tax, free from state tax, free from capital gains tax. Now, there's very few options for that, and I'm going to talk about that in the coming week. But one of the ones that most of you already know about is your Roth IRA. Roth IRA is a wonderful vehicle because it's truly tax-free. It grows tax-free while it's in the Roth IRA, and when you pull it out, it's still tax-free. There are some limitations to using a Roth. So if you're a higher wage earner, you're going to be impacted by those limitations. You may also need the money sooner. And if you put money in a Roth IRA, you got to wait 5 years to use that money. We'll talk a little bit more about that in coming videos, but I want to particularly get you thinking about what it looks like to live a tax-free retirement. Because if you can live a tax-free retirement, regardless of where tax rates go in this country, which we know they have to go up, you can actually go through your retirement years without having to worry about whether or not the money that you need then is going to be taxed at a 22% rate, a 44% rate, or how about this? In 1945, 1946, the highest marginal tax rate in this country was 94%. 94%. So if you can imagine your dollars today being taxed at double or even 3 times what you're currently being taxed at, that's what's so important about your retirement planning. So stay tuned as we talk more about a tax-free retirement.